PantheonAI presents Inflation Surge, JPMorgan Warns, ASML Downgrade, and Crypto Dip. Welcome to the PAI Morning Briefing. I'm John, your host from PantheonAI, and today is July 15th, 2025. Good morning, everyone.
And I'm Sarah. I hope you're all feeling energized and ready to dive into today's market insights, because we've got a lot to cover. John, let's jump right into a quick market overview, shall we?
Absolutely. Right off the bat, the major U.S. indexes are trading higher this morning. The S&P 500 is sitting at approximately 6,268.56, up by roughly 0.21%. The Dow Jones Industrial Average isn't far behind, currently around 44,459.6, adding a slight positive change close to 0.25%.
So a gentle nudge upwards then? It sounds like we're seeing some cautious optimism, especially with our tech-heavy Nasdaq trading at roughly 20,640.33, up by a modest 0.23%. It really does feel like the markets are just gently nudging higher, as investors digest mixed signals from a whole slew of economic reports and corporate news.
That's a great way to put it, Sarah. And not to be left out, our leading cryptocurrencies are also in the mix. Bitcoin, trading at nearly 117,829.96, has seen a bit of a correction, with a decline of about 1.68%. It's a good reminder that even the so-called blue-chip crypto asset isn't immune to volatility.
Right, it's never a straight line, is it? But then you have Ethereum, which is holding its ground pretty well at roughly 3,017.65, with a slight uptick of around 0.11%. It's always intriguing to see how these digital assets behave, in tandem with traditional equities as macroeconomic conditions shift. It's almost like they have their own little dance.
They certainly do. Now let's pivot to a deeper dive into the major market trends that are really capturing the attention of investors and traders today. And first up, inflation. It remains front and center.
Oh, inflation. It feels like we can't escape it, can we? Recent data reveals that consumer prices posted the biggest increase in June in 5 months. And that strong price pressure, John, it just might dim the Federal Reserve's chances of cutting interest rates anytime soon. In a climate where every percentage point counts, it really appears the inflation battle isn't over. And while there was some chatter about tariff-related inflation, the evidence seems less conclusive on that front.
Indeed. In addition to that, the latest U.S. June Core Consumer Price Index recorded a year-over-year reading of nearly 3%, which is just a hair above the previous month's estimates. With a month-over-month baseline creeping forward steadily, analysts are really wrestling with the impacts these figures might have on monetary policy decisions in the months ahead. It's almost as if the markets are playing this delicate balancing act between inflationary pressures and growth expectations.
A delicate balance, for sure. Meanwhile, a survey from Bank of America has shed light on an interesting development. Fund manager cash levels have actually dropped, triggering what some are seeing as a sell signal. Now, this could indicate a shift in investor sentiment, a possible move away from liquidity and toward riskier assets, or perhaps simply an opportunistic repositioning as market conditions evolve. It really begs the question, John. Are we witnessing an early signal that appetite for risk is solidifying? Or is this merely a transient adjustment in portfolio strategy?
That's a fantastic question, Sarah. And speaking of big players, JPMorgan Chase, the financial giant everyone watches closely, has topped earnings estimates for the 6th straight quarter. Despite another earnings beat that allowed its stock to rise, CEO Jamie Dimon cautioned about, quote, significant risks that continue to loom over the financial markets. His comments have certainly added an extra layer of intrigue to an overall resilient economic backdrop, prompting investors to wonder how a blend of robust earnings and persistent concerns might play out in the coming quarters.
It's that classic good news but scenario, isn't it? And on the technology front, semiconductor supplier ASML Holding finds itself under scrutiny. A broker downgrade ahead of its second quarter results has definitely raised eyebrows. The downgrade is reportedly linked to its key client, Intel, suggesting that pressures in the supply chain or shifting chip demand could be affecting forecasts. It's a stark reminder to all of us that even the titan of microchip equipment isn't entirely shielded from market headwinds. No company is an island, especially in tech.
Exactly. And across the Pacific, fresh warnings about potential economic shocks from China have surfaced. Two economics professors recently warned that the U.S. could be facing another major shock from China, possibly even a bigger one than the first wave we experienced. Their survival plan for the U.S. economy is certainly something to keep an eye on as global economic interdependencies continue to evolve. It's fascinating to see how geopolitical dynamics and economic forecasts are intertwined, sometimes in surprising ways.
It truly is. And speaking of mixed signals, Wells Fargo managed to snap its streak of revenue misses. But this victory was short-lived, as its stock fell due to net interest income missing expectations and a downgraded full-year growth outlook. It's a classic case of good news being tempered by cautionary signals, a situation that certainly keeps everyone on their toes.
It definitely does. Shifting gears slightly, there's also some exciting corporate news in the AI and financial services sphere. Anthropic, backed by Amazon, has rolled out its new Claude AI for financial services. The new tool is designed to aid financial professionals in making investment decisions, analyzing market trends, and conducting comprehensive research. It's a real nod toward the increasing integration of artificial intelligence in finance, a development that could soon change the landscape of market analysis for investors around the world.
Oh, that's huge. I mean, an AI co-pilot for investment decisions? It brings to mind the old saying that necessity is the mother of invention. But in this case, perhaps innovation is the co-pilot of investment. The idea that smart technology can help sift through mountains of data to pinpoint market opportunities is both exciting and, dare I say, a bit mind-boggling. I often wonder, in a world increasingly driven by algorithms, how well can human judgment keep pace when rapid-fire decisions are required?
That's a profound thought, Sarah. And then there's the political economic development that has sparked a lot of buzz, President Trump's new big, beautiful spending bill. The latest projections suggest that this measure could add approximately $3.4 trillion to federal deficits over the next decade. With debt figures already climbing more than 50% since 2020, this news is bound to make investors take a closer look at the long-term fiscal implications. While the phrasing might sound like it's straight out of an economic novel, the real takeaway is that long-term fiscal challenges are mounting, which could eventually influence everything from bond yields to broader market confidence.
Mounting indeed. And finally, in a piece of news that highlights continued consolidation in the investment space, Northleaf Capital Partners and AVALT have signed definitive agreements to acquire WASH Multifamily Holdings, Inc. This deal, which spans both the Toronto and Boston markets, represents an intriguing strategic move by private market players. It's an indicator of how firms are repositioning themselves for growth in the multifamily sector despite broader economic uncertainties. It's kind of like that old adage, don't put all your eggs in one basket, isn't it?
It really is. So with that rundown of the headline stories, let's dig a little deeper into each of these themes and talk about what they mean for various sectors, starting with technology. We've already touched on ASML's recent downgrade, and it's worth noting that the semiconductor industry is really at the heart of modern technology. With global demand for chips continuing to soar amid the expansion of everything from smartphones to electric vehicles, any disruption in the supply chain can create a domino effect.
Absolutely. For investors, the key takeaway here is to remain alert for signs of volatility. In the tech world, one misstep from a major player like ASML or Intel could send ripple effects throughout the entire market segment. It's so interconnected.
That interconnectedness is crucial. On the energy front, while there hasn't been as much headline-grabbing news today as in tech or finance, it's important to note that energy prices and supply chain disruptions continue to have a latent impact on global economic sentiments. With energy producers grappling with both geopolitical uncertainties and seasonal demand swings, traders should be alert for any shifts that might provide early signals for involuntary moves in broader commodity indexes.
It might not be the flashiest news out there, but energy is the lifeblood of nearly every industry you can think of, making it absolutely critical for the well-informed investor. It's the quiet mover, often.
It truly is. And that brings us to the financial sector, a cornerstone of today's discussion. JPMorgan Chase's continued dominance with 6 straight quarters of exceeding earnings expectations is certainly encouraging, yet it's tempered by Dimon's cautionary notes about lurking risks. The mixed signals here, Sarah, really serve as a microcosm for the broader markets, where positive corporate performance often stands in contrast to macroeconomic uncertainties like inflation and rising deficits.
And then, of course, Wells Fargo's stumble on revenue projections just compounds the message that even established financial institutions aren't immune to the challenges posed by today's economic headwinds. These disparities remind us that even within the finance sector, investors must remain vigilant and nuanced in their evaluations. It's a bit like watching a seasoned tightrope walker, confident and skilled, yet every step is measured to account for unexpected gusts of wind.
That's a perfect analogy. Stepping back to the broader global picture, the potential shock from China is perhaps one of the most critical issues to keep on your radar. Recent warnings by leading economists suggest that the U.S. could be hit by another sizable economic shock emanating from China, a scenario that might strain not only bilateral trade relationships but also the global supply chain.
And as China navigates its own economic transitions, the interconnectedness of global markets means that even subtle shifts could have outsized impacts on economies worldwide. This dynamic introduces an element of geopolitical risk that we simply cannot ignore, especially in today's hyper-connected financial ecosystem.
Absolutely. And it's in these uncertain times that innovations like Anthropic's Claude AI for financial services become all the more exciting. With tools that harness the power of artificial intelligence to dissect market trends and streamline investment decisions, we are truly witnessing the dawn of a new era in financial analysis.
Imagine having an AI co-pilot by your side, parsing through reams of data in real time and highlighting potential opportunities or risks that might otherwise fly under the radar. It's like having your own digital Sherlock Holmes, only way faster, and with none of the dreary weather impairing his work. Sure, it might seem like science fiction to some, but for those willing to embrace technology, the future of investing looks brighter and smarter than ever.
It really does. All right, let's pause for a moment and reflect on some thought-provoking questions. With inflation remaining a persistent force and the Fed's policy choices directly impacting market dynamics, how do you think the balance between controlling inflation and encouraging economic growth will play out in the coming months?
That's a huge one, John. And in the tech sector, as companies navigate the challenges of supply chain dependencies and shifting consumer trends, what lessons should we be taking away about risk management and long-term planning? I'd also invite you, our listeners, to ponder the implications of increased deficitary spending on the broader economy. How might rising federal deficits shape the fiscal environment for both governments and private investors over the next decade?
Excellent point, Sarah. Before wrapping up, let's highlight the key takeaways from today's discussion. Our major indexes, from the S&P 500 to the Nasdaq, are inching higher, bolstered by modest gains despite a mixed economic backdrop that includes a persistent inflation trend and cautious corporate earnings signals from financial giants like JPMorgan and Wells Fargo.
And in technology, that ASML downgrade is a stark reminder of the fragility even in the most advanced segments of the market. Meanwhile, geopolitical and fiscal uncertainties, whether from potential shocks originating in China or the long-term implications of a massive federal deficit, continue to make this a dynamic and challenging investment landscape. Each of these stories we discussed today isn't just a standalone headline. Instead, they're interconnected threads in the larger fabric of our global economy.
That's so true. Whether it's the oscillations of investor risk appetite, the calculated moves of major financial institutions, or the rapid evolution of artificial intelligence in financial services, every development has its ripple effect on the markets. And as always, the best approach is to stay informed, ask questions, and remain ready to adapt your investment strategy to an ever-changing environment.
Absolutely. As we bring today's briefing to a close, I'd like to give a shout out to PantheonAI, your information co-pilot. Our mission is to provide you with reliable, in-depth market analysis and insights that empower you to make informed decisions in this complex, vibrant financial landscape.
I hope you found today's discussion as engaging and thought-provoking as I did. Whether you're tuning in as a seasoned investor or someone who's just stepping into the world of trading, remember that learning shouldn't feel like a full-time job.
Exactly. What are your thoughts on the latest inflation data and the potential long-term impacts of the Fed's policy moves? How are you positioning your portfolio in light of the mixed signals from the financial sector? And with AI transforming the way we approach financial analysis, how do you foresee technology reshaping our investment strategies in the near future? These are questions we'd love for you to mull over. And, as always, feel free to ask more questions to our AI co-pilot during tomorrow's episode.
Thank you for joining us on this journey through today's market trends and news. Be sure to tune in again tomorrow for another edition of the PAI Morning Briefing. Until then, stay curious, Stay informed and keep questioning the status quo.
And remember, learning shouldn't feel like a full-time job. Have a fantastic day, everyone. Pantheon AI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.